Ever wondered about the difference between crypto ETNs and ETFs? Picture this. You're diving into the crypto investment world, and you stumble upon these terms. They might seem like just another crypto jargon, but they hold significant importance. For anyone venturing into crypto investments, understanding these terms is as crucial as knowing your Bitcoin from your Ethereum. Crypto ETNs and ETFs are not just fancy acronyms. They are investment vehicles that track indexes or benchmarks in the crypto world. And while they might seem similar, they have key differences that can impact your investment strategy and returns. But don't worry, it's not as complicated as it sounds. That's where we come in. This video is your guide to understanding what crypto ETNs and ETFs are, their similarities, their differences, and why you should care about them. So buckle up and get ready to dive deep. Dive in with us as we unravel the world of crypto ETNs and ETFs. Let's start with crypto ETFs. But what exactly is a crypto ETF? Allow me to unravel this for you. A crypto ETF, or exchange-traded fund, is a type of investment vehicle that tracks indexes or benchmarks, much like its traditional counterparts. However, instead of tracking conventional assets, crypto ETFs focus on the exciting and dynamic world of cryptocurrencies. But how do they do this, you may ask? Well, crypto ETFs own the underlying assets they track. This means that if a crypto ETF is tracking the value of Bitcoin, it physically holds a corresponding amount of Bitcoin. It's a bit like having a representative in the crypto world doing the legwork for you. Now, why would you want to invest in a crypto ETF? There are several reasons. Firstly, crypto ETFs generally have lower fees compared to direct cryptocurrency investment. This makes them a more cost-effective option for those who are cost-conscious or for those dipping their toes into the crypto waters for the first time. Secondly, crypto ETFs can be bought and sold on exchanges just like stocks. This means you can easily trade them during market hours, providing a level of convenience and flexibility that traditional cryptocurrency investments may not offer. But perhaps the most compelling benefit is that crypto ETFs allow you to invest in cryptocurrencies without actually owning them. This provides exposure to the potential profits of the crypto market without the complexities and risks of managing crypto wallets or private keys. So, crypto ETFs offer a less risky way to invest in cryptocurrencies without owning them directly. They provide a bridge between the traditional financial market and the burgeoning world of cryptocurrencies, encapsulating the best of both worlds. Exciting, isn't it? Now, let's move on to crypto ETNs. So what is a crypto ETN? In the world of finance, ETN stands for Exchange Traded Note. A crypto ETN is essentially a debt note issued by a bank. Unlike traditional bank-issued debt, though, crypto ETNs are designed to track the performance of a cryptocurrency, like Bitcoin or Ethereum, for example. Here's where things get a bit different from crypto ETFs. Unlike ETFs, which own the actual assets they're tracking, ETNs don't. Instead, they're backed by the credit of the issuing bank. In simpler terms, when you invest in a crypto ETN, you're not buying a piece of a Bitcoin or a slice of an Ethereum. Instead, you're lending your money to a bank, and in return, the bank promises to pay you back based on the performance of a specific cryptocurrency. Investing in a crypto ETN might sound like a good deal, but it's not without its risks. The most significant of these is the risk of the issuer defaulting. Remember, you're essentially lending your money to the bank. If that bank goes under, you could potentially lose your entire investment. That's a pretty big risk to consider. Furthermore, the value of a crypto ETN can fluctuate based on the credit rating of the issuing bank. If the bank's credit rating goes down, the value of your ETN could also go down, even if the cryptocurrency it's tracking is doing well. This is a unique risk to ETNs that you don't have with ETFs. So while crypto ETNs can offer exposure to the world of cryptocurrencies without the need to actually own any, they do come with their own set of risks. It's important to understand these risks and consider them carefully before deciding to invest. In essence, investing in a crypto ETN is like lending your money to a bank with the promise of a return based on a specific index or benchmark. Having understood both crypto ETFs and ETNs, it's time to compare them. On the surface, both crypto ETFs and ETNs seem similar. They are both types of exchange-traded products that track the performance of a certain benchmark, such as a selection of cryptocurrencies. However, the way they go about this is fundamentally different. Crypto ETFs are akin to a basket of goods. They actually own the cryptocurrencies they are tracking, and their value is derived from these underlying assets. This gives investors a level of security, as they have a claim to a tangible asset. However, it also means that ETFs are subject to the same price fluctuations as the cryptocurrencies themselves. On the other hand, crypto ETNs are more like a promise from a bank. They don't own the underlying assets, but instead track their performance. The bank issues a debt note, promising to pay the investor the return of the index minus fees. This setup allows for more flexibility and potentially higher returns, but it also carries the risk of the bank defaulting on its promise. Now, let's talk about the pros and cons. ETFs generally have lower fees and can be bought and sold on exchanges, just like stocks. ETNs, however, do not pay dividends or interest and carry the risk of the issuer defaulting. That being said, ETNs have a tax advantage as they do not pay taxable dividends and interest, but investors should consult tax professionals due to the complexity of their tax treatment. It's also important to remember that ETFs are more popular and widely traded, with the S&P 500 index tracking ETF being a favorite among investors. ETNs, in contrast, are considered riskier than ETFs due to the combination of default risk and market risk. The key takeaway here is that your choice between a crypto ETF and ETN should be based on your risk tolerance and investment goals. ETFs offer more security, but potentially lower returns. ETNs provide the opportunity for higher returns, but with a higher level of risk. While both offer unique advantages and risks, your choice between a crypto ETF and ETN will largely depend on your investment goals and risk tolerance. Let's quickly recap what we've learned today. We've delved into the world of crypto exchange-traded funds and exchange-traded notes, understanding their unique characteristics and differences. Crypto ETFs, they own the underlying assets they track, they come with lower fees, and they can be bought and sold on exchanges much like stocks. On the flip side, crypto ETNs, these are debt notes issued by a bank. They carry the risk of the issuer defaulting, but they do have a tax advantage as they do not pay taxable dividends and interest. It's crucial to remember that these two investment vehicles, while both tracking indexes or benchmarks, come with their own set of risks and rewards. Therefore, understanding them is key for anyone who's interested in dipping their toes into the vast ocean of crypto investments. And remember, it's always about risk tolerance and understanding of these options before making a choice between ETFs and ETNs. Stay informed, stay vigilant, and keep abreast of the latest developments in this dynamic field. Remember, informed decisions are always the best decisions. Keep exploring, keep learning,